Hello and welcome to the top 10 most likely unseen issues for the February strategic case study exam on reality TV company Evestar. So before we start, I'm just going to go through a bit of an introduction to this particular video and where I've got the information on and what you need to do with said information. So how have I come up with these top 10? Well, first of all, you look at the focus in the pre-scene. If there's a lot of material in the pre-scene on a certain topic, then it's likely that there is some kind of importance of that topic. It's likely to be brought up in the exam, so there's more to talk about. And that feeds into the second point here, the degree of importance attached to it by the examiner. But that particular section extends beyond purely what's in the pre-scene, but also what CIMA like to examine. For example, ethics. It may be that there's no real mention of ethics in the case study, but ethics is considered very important by CIMA and therefore they are likely to examine it. Next is the strategic importance. How important is it to the organization? If a certain topic is very important to the company, for example, say their suppliers, if they rely very heavily on a certain supplier, then it's likely that there might be an issue on the supplier. If something were to happen to that supplier, what impact could that have on the business? And also just a more general experience in doing these videos in creating mock exams and reviewing exams in the past, the typical kind of issues that come up and what kind of things have the examiner brought up in the past. And my final point here is about how easy it is to write issues on that subject. The people who write the exams are obviously people too, and they will go for ones that they know, that they can write good questions on. So what do you need to do for these issues? Well, first of all, it's important to prepare key models. So this will be things like your SWOT exam, like SWOT analysis, like your PESTLE analysis. Because building up this information now will help you to adapt the new information given you in the unseen, or help you to have that context to apply the unseen material. Next thing you need to do is practice exam questions on these issues. This will help you to understand the kind of questions that will be asked around these topics and how to answer them. And also, this next section here, it will help you to plan these answers in your mind so that when you go into the exam and you start writing, you'll already have a background in which to apply this new information. You'll already have certain points to bring up in your head as you're writing for them. And I've also put some more generic things here, such as the advantages and disadvantages of these certain topics, where they would be used and how models can be used to support them. So let's move on to the top 10 issues now. So we'll start with issue number 10, which is on funding. Now, the reason why I've chosen funding is because it's a key F3 topic, and a big portion of the technical marks that you'll gain in your exam will be from F3 subjects, which of course the examiner needs to fit in somewhere. And so the key F3 topics that come up with regards to funding are equity financing, debt funding, cost of capital, and also dividend policies. Now, dividend policy being quite important to this particular case because, of course, there was arguments in the pre-scene that the company was paying too much in dividends and wasn't reinvesting enough in the company. It's also important because it comes up as part of other questions. Whilst you may not be given a question on funding itself in the exam, you might be given a question relating to a new project, a new show, entering a new market, whatever it is, but of course you may need to have funding to do with it. You may need to raise financing, raise additional funding to go ahead with that project. So of course it's then a tag-on topic that you need to be aware of. And this happens all the time, variant after variant, sitting after sitting. It's very commonly examined. And also, it was mentioned as part of your role in CIMA's SCS guide, the general theme of suggesting how to raise finance for particular projects. Another reason why it's particularly important to Evestar is because as we went through the pre-scene, we did see that it perhaps was hinting at the fact that they need to branch into new shows, hinting at the fact that they were perhaps standing still when the rest of the industry was moving forward, and therefore would perhaps need to look at investing in new things. But of course, the company is currently quite short on cash. Now, by short, I mean 40 million Teelan dollars, which sounds like a lot, but given that it costs over $1 million Teelan dollars just to create one episode of their flagship program Teelan Variety, that 14 million Teelan dollars may go very quickly. And they may even end up in cash flow problems if that were to continue. Because looking at the past 5 years of the organization, we saw that a few years ago they had over 50 million in cash and cash reserves, and that has declined year on year on year. So if that is a recurring theme, then in a few years' time they may be in negative cash flow, which of course will cause issues with short-term working capital. Now, when it comes to long-term funding requirements, this could be in relation to new projects, such as new television shows or branching into new markets, new products, etc. It could also be to do with acquiring another company, another production company, smaller production company that already creates some of the shows that they are looking to branch into. It could also be acquiring a supplier or acquiring a network so that they can integrate themselves in the network world, and thus perhaps give them some extra power when it comes to being in charge of their own shows, rather than relying on the other major networks. And again, I reiterate the fact that that's most likely to be as an add-on to an investment issue. So key points from the pre-scene to bring up when you're talking about funding, when you're talking about financing, that currently they have 14 million Teelan dollars, which again, as I said, may not be that much in this particular industry. And another common misconception that people often make is they assume that all 14 million Teelan dollars of this is freely available to do with as they please. But of course, it's not. A lot of that will be needed for general working capital, so paying off their trade payables, cash needed for the monthly wages of all the people working for the production company. And of course, again, reiterating the fact that it costs so much to create just one episode of their programs, which actually paints the picture that there is very limited cash available for investment. Now, this is particularly a problem given that the pre-scene is hinting at the fact that they do need to invest, they do need to reinvest money in the company, and they need to expand and grow. It's also generally part of a company's financial strategy to have a reasonable amount of spare money. And this is for instances where you may have a negative cash flow. If you're going to have a few lean months where you're going to be, in a sense, losing money, you have to have a bumper safety net of financing available for those periods. You cannot rely on the fact that you're always going to be profitable month after month. And the fact that they don't have that may be indicative of a poor approach to financial strategy or a weakness in their financial strategy. The common way in which the company has raised finance in the past is through debt financing, usually in the form of bonds. And as we saw in the pre-scene, this has been all right until recently, where the credit rating agencies had lowered the values of Evestar bonds, and bondholders were getting frustrated by the fact that the company seemed to be refusing to take on additional equity financing. And they insisted on paying out lots in dividends rather than reinvesting it in the company. We saw that their retained earnings had barely gone up at all in the last 5 years. And in some years it had actually gone down, signalling that perhaps they had paid out more dividends than they'd actually made in that year. But going forward, they could be in a position where they cannot do anything but raise money by reinvesting profits or by raising additional money on the stock market, because their gearing is now so high. It's at 59% using the debt over debt plus equity method, and 144% using the debt over equity method. So there's very little room for extra debt financing, particularly in that way. The only other thing they could do to raise additional debt financing is to either sell some of their non-current assets or use it as security to raise debt against. We saw that they have over 372 million in non-current tangible assets. So that's a lot of money tied up in assets that could perhaps be released to help improve the liquidity of the organization. I'm just going to talk through the standard order of using finance, of raising finance and using finance for projects. Usually you would start by using the cash you have available. This is obviously the most efficient way of using your finance because it's money that you already have. It's not costing you anything to use it. However, given that they do not have that much cash available, it's unlikely that they'll be able to use it for anything other than small projects. For larger projects, they'll have to raise debt or equity financing. Now, ordinarily, you would use debt funding first, securing finance against your asset base, or purely via a loan from the bank. The problem with pure loans from the bank is that the interest rates can be quite high, which of course ties back into the Thailand economy as well. What are the interest rates like in Thailand at the moment? If the interest rates are very high, then it makes raising debt via loans very expensive. And equity is usually the last because of the cost and the time involved in raising money, going on the stock markets, etc. We know they are currently a publicly traded company, so they do have that option. However, we also have to think about our existing shareholders. We have to agree with them to raise more equity on the stock market, and if they do not agree to that, then we may be stuck. The problem for Evestar is that this may be the only option. We've already seen that their current gearing is incredibly high, and that existing bondholders are increasingly frustrated by the fact that the company seems to refuse to take on additional equity financing. And the key theories using when discussing these various ways of raising finance is to look at the advantages and disadvantages of each. So we know that debt financing is quick. We know it's generally low cost, especially in comparison to equity funding. But at the same time, we do not have to pay the capital back with equity. There's nothing to say that we have to pay dividends. I mean, some shareholders will want dividends, and if they do not get them, they may eventually sell their shares and move on, but they are still optional, which of course is the opposite of interest payments, which interest payments are mandatory. If you miss your interest payments, you risk damaging your credit rating further, and also you risk losing those assets that you've secured that debt financing against. And another key model that you should always be thinking about when you're talking about raising more money for the company, given that you're going to be perhaps bringing in new stakeholders, new shareholders, etc., is the stakeholder matrix. Of course, you have to think about your existing shareholders, how they're going to react to the news. You have to think about your employees. How are they going to react to the fact that they may be doing new projects now going forward? Will they be skilled enough? Will we have to bring on new employees, etc.? So these are all things to consider. Now, issue 9, which is risk management. Now, risk management, again, is another key topic that comes up very regularly in the strategic case study exam. And this is one of your big P3 topics this time, which may often fall in either the technical or business competency. And the individual topics that generally fall under this larger heading of risk management are identifying risks, managing those risks, mapping those risks, and also how to control those risks in the future. And of course, more evidence as to why risk may be a likely topic is that there was an entire section in the pre-scene covering those key risks. Now, why would they put that in if they weren't intending it to be used in some way, shape or form in the actual exam? So likely issues could be identifying the key risks in a specific project. So this could tie in with a subject on going into a new product or a new market, or just going ahead with a new project on anything. Of course, if it's something that we haven't done before, it could be risky. We need to now think about what could go wrong. If we are talking about investing in a television network, our own television network, what are the possible risks for that? It's something that we have no experience in. What if by pulling out of the major networks and putting all our own shows on this new television network that we've produced, what if the viewing public view that as a betrayal towards InTV or national television? What if they associate Teal and Variety with InTV and are not willing to watch it on the Evestar network or whatever we call our new TV channel? We also have to think about how we're going to raise money for that particular project, and we also have to think about where our revenue is going to come from. Now, we know that in Tealand, other than national television, all of the TV networks raise money or raise revenue through advertising. But the networks have the connections with these companies. We don't have those connections with the companies that sell adverts. So if we don't have the connections with the companies that are going to want to put adverts on during our shows, we're not going to be raising the kind of revenue that we would expect. And that would, of course, be a risk of the project. And then once we've identified these risks, we may need to look at how we're going to manage them and control them. And this could be during that project or a different project, or it could be for the organization as a whole. As in, is the company, does it have efficient risk management systems in place at present, or is there a bit of a weakness? Is that a bit of a weakness for the company that it doesn't effectively control its risks? An example of this could be the fact that when it came to the governance page, it spoke about how it doesn't actually comply with the Tealand Code of Corporate Governance, which could be considered a weakness in its approach to risk management. Then you could talk about how the company should be managing its risks. An example I've put here is the role of the audit committee. Now, again, during the governance page, there was no mention of an audit committee, which of course is a committee comprised of non-executive directors, ensuring that the operations of the company are all above board. Now again, if there's no audit committee, that again is a weakness in the company's approach to risk management. Some of the risks that were outlined in the pre-scene, the rise of competition, the rise of companies like Bonchance seem to be getting stronger year on year, whereas Evestar perhaps isn't. A real lack of development, no new shows for the past 3 years, and people getting bored with the current shows provided by the company. Strategy as well, no clear direction for where the organization was heading. Do they have a grand plan for where they want the company to be in 10 years? Do they have a proper financial strategy to ensure that they've got enough money to deal with lean times, so to speak? Governance, one I've already mentioned. That there is a code of governance that is applicable to publicly traded companies in Tealand, and yet they do not comply with that code, which is likely to upset shareholders in the long run. Also, safety of personnel, be that contestants, be that judges, be that people who work for Evestar. This is one that is perhaps quite difficult to control, particularly when it comes to psychological harm, which was mentioned in the pre-scene, but of course the public are not going to see it that way, and therefore it could be a huge public relations risk if someone does something because they were suffering from stress, whilst appearing on one of Evestar's shows, and then there's newspaper articles saying, oh, Evestar should have done more, Evestar should have recognised that this person was going through tough times, etc. And this leads the public to be aware of the issues and hardships faced by members or contestants of the show, and because of course they're aware of Evestar and aware that Evestar is a profit-making company, etc., this may lead to them protesting it out of concern for the well-being and the operations of Evestar. And of course there is precedent for this, with Celebrity Restaurant, one of Bonchan's shows, being protested recently, and this was mentioned in one of the articles within the pre-scene. And when you're talking about risks and when you're talking about how to control them, you must talk about the importance of it, the reasons why we must control risks, particularly at SCS level more so than at management or operational level. And also explain how the risks management processes that you are proposing, how they'll help manage those risks. And of course, very common theories that you can use when talking about risk would be the COSO risk methodology here. As you can see, I've given you the diagram for that. Also, the risk management Tara model. The thing about the risk management Tara model is that you can often look at a risk that you've identified and then just talk about how each of these might impact it. So, for example, if you have the risk that someone might get injured on your show, you could transfer that risk by perhaps taking out insurance or ensuring that all contestants on the show take out personal liability insurance to remove the liability from Evestar themselves. You could accept this, just saying that's the way it happens. You could reduce it by bringing on more health and safety staff who ensure that everything is up to code, or you could avoid it by just not putting the show on altogether, which of course is unlikely to be the preferred choice of action, because you need to put on the show, because that's how the company makes money. Risk mapping, so this is, as we saw in the pre-scene, where you look at the potential impact on the business and also the likelihood of it happening. You give it a score for each of those, and then you add them together or times them together, and that gives you your overall risk mapping score of it. And obviously the higher the number, the more you need to do to prevent it from happening. If it's something that only has a 1 out of 5 for impact and a 1 out of 5 for likelihood, don't go putting all your eggs in that basket, so to speak, of taking care of that risk, because even if that risk happens, it's not really going to have a huge issue, cause a huge issue for your business. Whereas if something has a 5 out of 5 for impact and a 5 out of 5 for likelihood, then you should be doing all you can to mitigate the impact of it or to stop it happening altogether. And audit committees also help to manage risk, because that's part of their job, and this is again one of the weaknesses of the company if it doesn't have an audit committee. We do not know for certain yet, but it did not mention it in this section on governance, and of course that is a weakness in their approach to risk management. So I hope you've enjoyed this sample video and more importantly found it useful. Before I go, I'd like to quickly tell you about a few of the products that we do here at Astranti Financial Training, specifically for our case study courses. We have a study text which details all the key theories in which you will be expected to use in your case study exam, as well as details of how to approach the pre-scene and the case study. We also have a series of course videos detailing how to answer case study questions. This is actually an area in which many students struggle. Most of the scripts that I've seen, the failing scripts that I've seen, has actually been due to poor case study technique rather than lack of knowledge. We also have a series of pre-scene analysis videos based on the current up-to-date pre-scene, detailing all the key bits of information and likely issues you may face in the exam. Next up is the industry analysis, a pack detailing information about the industry that the pre-scene company resides in, information about the key players within that industry and more background information on the industry in general. We also have a range of mock exams created for each level and based on the current pre-CIMA, which is a great way to get some practice in before you sit the real thing. We also offer marking and feedback on those mock exams so you can see where you are going wrong and where you can improve. Finally, we have the master classes. These are 2 one-day classes taken by our expert tutors to give you all the hints and tips you need to really add to your chances of passing the exam. Also, if you take our full course, we offer a pass guarantee, which, provided you have met all the requirements of the pass guarantee, you will get a free resit on the next exam should you fail to pass. So once again, thank you for your time. If you're interested in any of these products, please visit the website www.astranti.com for more information. Thank you.